Hi, this is Gigi of the BoringTrader.com website. This is week 10, covering the first week of June. Not much to say in general. The week started, I wouldn't say too well, but it got better towards the end, posting a theoretical, I just stress this, theoretical profits of about 10R for all the trade management styles. You can read the blog for the stats. I would say here, however, that if you look at the blue line here, which is the one-to-one reward risk trade management style, and the gray one, which is the half-to-one reward risk trade management style, you will notice what we have already seen in the past. When volatility is low and the system does not perform so well, the blue line suffers. You can see it here. The gray line, however, comes to the rescue, overperforming it. When volatility is higher and the system works better and more 1R targets are hit, the blue line outperforms the gray line. There are some nuances, of course, as we have seen last week, at single instrument levels. Some instruments work better with half-to-one, some instruments works better with one-to-one. But the trading style that we are looking at are about equivalent in terms of results. I also have introduced the orange line that shows the result for a compromise strategy, if you like. Half position taken at half R and half position taken at 1. Notice that this strategy, maximum profit per trade, is also a compromise. It's a 0.75 to 1 reward risk. The advantage is that you still hit more half R when the volatility is low, but you have the chance to participate in the 1R targets when things move in your direction. And again, yeah, you can argue that from this overall curve, you have a little bit of an edge with a half-to-one, but it's really not that different, and it's basically a matter of personal preference. On the website, you will find also this chart, which is the performance of the 15 minutes breakout system in May. As you can see, it's quite equivalent to how the system performed in April, and there's some more information over there if you're interested. I won't dwell too much on this week's statistics, but rather I will take some time now to show a couple of examples to discuss the long debate of fully automatic systems versus semi-automatic system. It would also be useful, I think, to show how the use of different filtering techniques will make the performance of the same basic system to diverge greatly. Okay, this is euro against the yen. This is not the chart I'm using, it's not the account I'm using, this is just for illustration purposes. This is the line of London Open. This is when we start trading. So the first breakout signal is a little bit above this level here. Now, first thing to show is that if you have a totally automated system, the totally automated system will look into this. Let's talk about the totally automated system I have managed to test, which is probably a very, very poor version of something that quants can do much better than I can. But anyway, I'm talking about me. So the system will enter here, and this is a pretty bad place to enter. I don't know if you notice, but here we had quite a lot of resistance. The market pushes up, and this is really a big wick. First of all, I wouldn't have entered this. I would have filtered this on the basis of this resistance here. A fully automated system that doesn't take this into account, and I don't really know how to tell it to take this into account, will have entered, and it would have been a loss. The second part is the second trade is this one. You enter short. There is quite enough space to test this level here. And if you look and you use some other levels that I use, like the pivot, for instance, the pivot is quite a magnet for this particular trade. So this would have been a good trade. It's a trade that I wouldn't have filtered, and it's a trade that the fully automated system would have taken anyway. Let's look at the third trade. There's quite a lot to talk about this. You can use this signal here, or you can use the previous one, because the resistance was found at this particular level. So this is already a potential divergence between two people using the same system, and some people a little bit can be a little bit more aggressive and enter at this level, and some people can be a little bit more cautious and think that it's better if we wait for this particular level. A fully automated system wouldn't look at this kind of things. It will see this level, calculate a little buffer that you can program, and enter. What happens to this trade is that the market doesn't really reach this level here that was tested twice. So that's a sign of weakness in a way. And also, there is another issue here, and it's the issue of the totally automated trade management that we want to use. If you can use something and you have time to adjust to exactly your preferences, you basically would have used this level here as your stop. I don't have that luxury, because otherwise I will have to focus on one or two markets or three maximum. So I just standardized my fully automated trade management with a fixed number of lots, a fixed number of points or ticks or pips, whatever you want to call it, which are based on the historical volatility of this particular market. For euro against the yen is 20 points. It's general compromise, if you like. If I do this, I just can click into my trade management system, and the trade management takes care of everything, the stop, the targets, and so on. Otherwise, I will need to set the entry, the stop, calculate the risk, and blah, 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 and I really can't do that. But if I do this, these 20 points are just about right, but you see, the real support, the last support, was actually at this level here. I'm quite happy to go with it, because this is the area of support, basically. So I feel relatively relaxed about this. But what is more important is here, the market goes up, almost reaches half hour, but it doesn't really make it, and it's basically pushed down twice. Now, if I just leave the position there, the position will be still in because I wouldn't have been stopped out here, but I would have basically risked a loss after I basically went 2 points from the first target. So in this circumstance, I would put the stop at break even manually. And that's another example of how you can actually try to make the system better. But again, I must stress this. You don't know if your actions are making the system better if you can't benchmark against the system itself. Every action I do, is it better or is it worse in respect to the system? Sometimes, like in this case, it's better. Sometimes it's the same. Sometimes it's probably better. Sometimes it's worse. And we will see a couple of examples later on. But the bad day didn't stop here. Here we have a sell signal. And we should try to enter. And the fully automated system will have entered here. The idea is to test this area that we have seen was support, but we didn't have the chance. So in this particular case, this would have been a loss. And together with this would have been 2 losses against 1 win and 1 break even. Again, the calculation of the volatility, really very rough calculation. This is 20 points. Would have been not really a clever one, because the real resistance here would have been up here, would have been a little bit more, but that wouldn't have made a big difference. And then we had another entry, long, at this level. Again, the idea is to test this level here, but the market decided not to test it. What you can see here is that it's the same as this one. As you can see, the market almost reached the half hour, and then it went down. And the fully automated system without any intervention would have kept you in, and here you would have had a loss. Here, to me, manually, I would have closed the position at break even. So minimizing the possibilities of losing this one. So as you can see, this particular day wasn't very good for the euro against the yen. But if you look at the chart, really, we are based on a breakout system, and apart from this, which was a true breakout, you really can see that this is not a fertile ground for a breakout system, and in fact this wasn't very good. Based on that, it doesn't take a genius to understand that the 2nd of June, Tuesday, was a much better day. This is the time we start trading, the London Open, and you can see this marked difference between what happened in this day and what happened in this day. So you would have entered here, had the first big win here, have another big win here, and have another big win here. So in this particular instance, a totally automated system that doesn't really need to look at anything else would be fantastic. And when you have that sort of volatility, any breakout system, which is also based a bit on the trend following, makes a lot of sense. Now let's look into detail at what happens when you probably try to be a little bit too smart for the system. This is the first trade in the morning. If you had other levels that I usually look at, like for instance the pivot. This is R1. You see that this trade went in, bounced with almost a reversal bar on R1, and what happened then was that it went up again and it rebounced with a double top at this level. So at these points I would have said, look, this is R1, it has been tested twice, it is quite important, I'm not going to use this. I'm going to close the position at break even and wait for a better trade. This particular system doesn't allow you to wait for a better trade, in the sense that you will need to wait for this line to move up, and sometimes you don't have that chance. So you had a big shoot up here, and it went without you. So if you're using R1 or the pivots, pivot R2 and so on, you have to journal this as a zero, a break-even trade. But that's worse, because here you finally have this line that catches up with this latest high, and you could re-enter here, and this would have been another great trade. However, again, if you're using the pivots, you wouldn't take this trade because it would be straight on R3, and statistically very few times the market goes much higher than R3. I think I remember that they just reverse something like between 75 and 80% of the time. So the stats are against you here, and so you might not want to trade this one, or want to enter this one, because it was bang on R3. Some other people may say, okay, look, this is R3, but if I put a bigger buffer, I will catch it anyway if there is a big rally. And some people may just decide that it's not for them. So you would have had a great day, but if you were using quite strictly this pivots points, you would have been quite frustrated. You would have missed two, but all is not lost, because eventually you would have got up on this one. There is no obstacle on this one. Okay, the rally was definitely overextended, but this was a very big day, and as you can see, the bears could have stopped this here. They didn't. There was a new breakout of this reversal bar, and this is a classic breakout trade, and that would have got you up there. And then again, it depends on what your trading style is, because if you want to put the stop at break even once the market has gone close or hit your half hour, this would have been a break even. So you would have had break even, possibly no trade, and another break even in a market that went up 1 billion points. This is where you actually can override the system, in my opinion, when you can read price action and what the market does. But as you can see, you can give this system with these slightly different rules to 10 people, and you will have 10 different outcomes. The most important thing is that each one of them has to journal, and each one of them has to journal consistently to the rules he or she is playing by. And only by looking at this and comparing it to the other rules, what would have happened if I ignore this R3? Now, you have to look at it and check it in your journal compared to all the other R3. Today, it was on the 2nd of June, it was a great idea to ignore this. But if your statistics are telling you that not taking trades at R3 would have saved you 12 hours, well, this little 1 hour doesn't really make any sense. So again, it's journal, journal, journal. I hope this wasn't too confusing. Of course, any questions, ask.